Most beginners think investing early guarantees wealth, but the numbers tell a brutal story that most financial gurus are too afraid to share with you. We have been sold a dream that simply starting in your 20s is a magic ticket to retirement. Yet by the time 80% of people hit the age of 30, their total retirement savings is still less than $10,000. If the math is so simple, why is the reality so bleak? Today I am pulling back the curtain on the harsh data that the industry hides behind glossy brochures. I am going to reveal 3 specific, shocking numbers that will fundamentally change how you see early investing forever. We are moving past the surface level advice to look at the cold, hard statistics that determine who actually builds a fortune and who ends up with nothing but a decade of wasted time. The problem is that we are constantly fed myths like start young and get rich fast, or that compound interest is a form of effortless magic. While the math of compounding is real, the reality of human behavior and market mechanics is much messier. Most early investors lose patience or get completely discouraged when they see their accounts barely moving after 3 years of sacrifice. They see the small returns and think the system is rigged, not realizing that the first stage of wealth building is often the most painful and least rewarding. If early investing is supposed to be the ultimate shortcut, why do 70% of young investors see almost zero real progress in their first 5 years? It is because they are fighting against a set of brutal numbers they do not even know exist. They are battling hidden forces that eat their capital before it ever has a chance to grow. To survive this journey, you need to stop looking at the potential upside and start looking at the structural traps that keep most people broke despite their best intentions. This brings us to number 1, the hidden cost number. This is the statistic that silently kills your dreams before they even take root. Most people look at a stock market return of 8 or 10% and think that is what they get to keep. They are wrong. When you factor in the combination of management fees, taxes, and inflation, your real return is often less than half of what you see on paper. Let us look at a real-world example that shocks most people. If you invest $1,000 a month with a 2% annual fee, which is common in many managed funds or through hidden layers of expense ratios, over 20 years, you do not just lose 2% of your money. Because of the lost opportunity for that money to compound, you actually lose nearly 35% of your total potential portfolio to fees alone. That is hundreds of thousands of dollars handed over to a bank for doing almost nothing. Combine that with an average inflation rate of 3%, and your purchasing power is being eroded faster than you can build it. Most professional investors are terrified of this number, yet the average beginner does not even know how to check their expense ratio. They assume the market will carry them, but these hidden costs act like an anchor on a ship. If you do not account for the silent leak in your bucket, it does not matter how much water you pour in. Number 2 is the time versus growth number. We are often told that time is your greatest asset in early investing, and while that is true, it is also a dangerous oversimplification. People often overestimate their potential returns by 50% or more. You see the headlines about crypto millionaires or tech stocks going to the moon, and you assume a 15% return is normal. It is not. The realistic historical average for a diversified beginner portfolio, after adjusting for the inevitable mistakes and timing issues, is much closer to 7%. The difference between a 7% return and a 10% return over 30 years is staggering. If you invest $5,000 a year at 10% for 30 years, you end up with about $822,000. But at 7%, that same $5,000 a year only grows to about $472,000. That is a gap of $350,000 based on a mere 3% difference in growth. Most people are basing their entire retirement strategy on a growth rate that is statistically unlikely for them to maintain consistently. Are you one of the people overestimating your future growth by 50%? If so, your plan is not a plan. It is a gamble. You have to understand that the margin for error in your growth assumptions is much smaller than you think. Number 3 is the risk and loss number. This is perhaps the most brutal reality of all because it involves the psychology of failure. Early investors have a documented tendency to panic sell during market dips. Statistics show that the average retail investor underperforms the market by a massive margin because they buy when things are expensive and sell when they are crashing. Here is the number that shows how one mistake can wipe out years of growth. If your portfolio drops by 50% in a market crash, which has happened multiple times in history, you do not need a 50% gain to get back to where you were. You need a 100% gain just to break even. If you are in your 20s or 30s and you experience a major crash, the time it takes to recover can span 5 to 10 years of your prime earning life. One emotional decision during a volatility spike can effectively delete a decade of disciplined saving. This is the number that breaks most people. They see their hard-earned money vanishing during a recession and they exit the market, missing the recovery and cementing their losses forever. The math of loss is much more aggressive than the math of gain, and if you do not have the stomach for the brutal swings of the market, the numbers will eventually work against you. So how do you make these brutal numbers work for your benefit instead of your destruction? It starts by shifting your focus from timing the market to the raw power of consistency. Wealth building is not about finding the perfect stock. It is about the relentless habit of staying invested regardless of the headlines. You need to prioritize low-cost index funds and tax-efficient accounts like a Roth IRA or a 401k to combat the hidden costs we discussed. By keeping your fees below 0.1% instead of 2%, you are effectively giving yourself a massive raise that compounds every single year. You also need to base your financial projections on a conservative 6 or 7% return rather than the inflated numbers you see on social media. If you plan for the worst and the market performs better, you simply end up wealthier. But if you plan for the best and the market underperforms, you end up in a crisis. Understanding realistic growth rates allows you to set a savings rate that actually covers your future needs. The goal is to build a system that is robust enough to survive volatility, meaning you keep enough cash on hand so you are never forced to sell your investments when the market is down. Most financial gurus won't tell you this paradoxical tip. Starting later with a wiser, higher income plan can outperform foolish early investing, according to a secret statistic. Starting at 20 is great, but successful investors often invest in their own earning potential first. Someone who starts investing at 30 with a 6-figure salary and a disciplined, low-fee strategy frequently has a bigger net worth by 50 than someone who started at 20 with a low earnings and high-fee mutual funds. Your savings rate, the difference between what you earn and what you spend, is more important than your investment return in the first 15 years of your journey. Small tax and fee changes always beat reckless stock picking. Being durable over time is more important than being fast out of the gate. These terrible numbers are meant to inform, not deter. Most players fail because they don't know the rules. You can create a winning strategy by understanding hidden costs, growth fantasies, and loss math. Comment below, which statistics surprised you most? Were hidden fees or crash recovery math to blame? These data-driven methods will save you thousands of dollars and years of frustration if you want to invest early and develop wealth. Discuss this with a buddy who is just starting out and needs a reality check before making an expensive mistake. If this analysis was helpful, like and subscribe for more in-depth financial guidance. Enable notifications to never miss expert-only data. You'll thank yourself later for studying numbers today.